and we're very lucky to have Todd Langford back with us, the creator of Truth Concepts, to get the math and the numbers behind some of the statements that we hear in the big wide world. And we were at a conference not too long ago with thousands of individuals. And the guy speaking from the stage was strongly encouraging the audience to not buy insurance because whole life insurance is very expensive. And term, although could be a good option, it's very cheap, but those greedy insurance companies, they take all your money because there's a low chance of the term paying out. So we hear this one a lot. Term is very cheap, whole life is very expensive. And so number one, that's one issue. Number two, why would you even buy a whole life insurance policy? Because the returns are so low, you'd be better off just taking that money, putting it in the stock market, paying someone a couple points to manage it for you, and become so wealthy that you could just self-insure. So let's talk through, that's probably one of the most common ones that we hear in the world, Todd, is whole life is expensive. It's got a low rate of return. Any American that's heard of whole life insurance can pretty much regurgitate those two things in one sentence. Yep. Whole life insurance, low rate of return, expensive to own. So let's break that down and really think about what's going on.
Yeah, I think from the initial get-go, where that's come from is a lot of people just haven't looked at it to see what it really is. And you know, there's an old saying that if you tell a lie 7 times, it becomes truth. And so, you know, the life insurance industry is easy to beat up, and the life insurance industry really doesn't defend itself. Some of the knocks have been earned, but you know, I get to deal with people like you guys who are at the top of the industry, really put their clients first, and that is the important piece. And we need to get that word out there to people so that they can understand how this really works. What is the real breakdown? And one of the things we mentioned on an earlier video was, you know, almost always the misinformation comes from unequal comparisons. And so there's comparisons that are going on that just aren't on the same page. And a big one is comparing gross to net, right? It's like, okay, so the life insurance policy is doing, let's call it 4% over time. Well, I can do better than that. I can do, you know, 8% in the market or something like that. But that 8% is gross compared to net. And so from the 8%, commissions have to come out of there, fees have to come out of there, taxes have to come out of there, and it's already handled on the comparison on the life insurance side. So it's just unequal comparisons, because yes, if it were true, 4% is a lot less than 8. That is a mathematical fact, okay? So let's dig in. I think it's going to probably be easier to use a calculator to kind of help us talk through some of these pieces, unless you have something else from the beginning.
No, I think we need to pull up a funding illustration. You know, when I first started using this close to 5 years ago, Todd, this is the calculator that changed my business, because it helped me and my clients understand that one, whole life insurance is not an investment. So when we compare returns on a whole life policy to a stock market, which is what we hear from a lot of financial advisors, and they just don't know what they don't know. So they're taking an average rate of return of 8% in whatever fund, and they're comparing it to 3 to 4% in an insurance contract. And they're saying, why would you, one, it's so expensive. 2, the rate of return is so low, so you're better off just putting it in the stock market. But right there, we separated a guaranteed savings environment to an investment grade vehicles. Investment grade vehicles should have a higher return than a savings component, because they do separate things. Like we've got to stop putting these together. And this calculator is, in my opinion, my personal favorite, because it helps illustrate that story.
Same for me too, which is why I created this one, because it's an area that is just hard for people to understand, and mainly because of the rhetoric. Nobody looks at it honestly, because, quote, everybody knows life insurance is a terrible investment, right? And so here's a place that people who want to really look in can kind of see what's going on. And if we look at this, so this is a policy that has a $20,000 premium. The death benefit starts here at $575,000, and it grows over this 80 years out to,
Do you want to use 80 years, Todd, or you want to use something
yeah,
like 40?
yeah. Let's use like 35 years. This will take them out to age 70 and just look at that point in time. And so this death benefit grows over time to $2.2 million. And it's kind of an interesting thing. You know, I don't know how many of you listen to Dave Ramsey and some other pieces, but one of the things Dave Ramsey says is, well, you know, life insurance is terrible because you only get the death benefit, you don't get the cash. Well, wait a second. This policy had a death benefit that started at $575,000. And if death were to occur out at age 70, the heirs would get $2.2 million. It looks like we got the death benefit plus other things. I don't know where he gets his numbers sometimes, but hey. So here, the cash portion, again, starts at $14,000 the first year and grows to $1.3 million over this time frame. And if we looked at what is the rate of return, in other words, what if we put $20,000 in investment to get to $1.3 million, what would we have to earn out there over that time frame? And actually, if you'll just click on the little dial up there in the top, then we can see up here, it shows us 3.35% net rate of return over that 35 years. So what that means is we earn the equivalent of 3.35% every year. And that gets a little bit confusing for some people because a life insurance policy actually has a negative rate of return up front. And we can see this. We put in $20,000, we only have $14,000 in that first year. So it actually has a lower rate of return up front, but it earned a lot more than 3.35 on the back end, so that it earned the equivalent of 3.35% every year. And I think let's take this to an alternate account and we can kind of see how that works. So what we're going to say is, what if we didn't put the money in a life insurance policy? What if we put it in another place and we earn that same 3.35%? So if you right click on the 3.35% up there, there's an option to copy it actually to the, yep. And that'll put it in there with all the decimal places. And if we go to our alternate account over on the right, then we can see here's an account we put $20,000 in, same 20 we had an option to put in the life insurance policy, but we're earning 3.35% every single year, and we have the same $1,317,000 we had in the life insurance cash value. So while the life insurance didn't earn that up front, it earned the equivalent of it over time. And I know a lot of people get focused on the front end, even to the point of having less long-term because they want to see money, you know, more money up front. And it's really the wrong conversation. How long are we going to be on Earth? You know, that's our lifetime. So what happens over time is really way more important than what's up front. We even see people say, well, you know, that's why I put money in my qualified plan, my 401k or 403b or whatever else, because I like seeing that money. Well, you're concerned about money up front, but you don't have that money until you're 59 and a half. Right? You can't even access it. So what difference does it make on the money up front? What we want to look at is how does it perform over time and what's along the way that we can take advantage of. But let's just say, for instance, that we could earn 3.35% somewhere. If we could do that in, say, a bond account or something like that, which is more relative to the way a life insurance policy works, because of the cash aspect, it's actually closer to like a checking account, a savings account, but we're not getting anywhere near 3.35%. But if we could, in any of those assets, would we have to pay income taxes on those annually?
Yes.
Yeah, and so if we put income tax bracket, and let's just put a 28% bracket in here. With a 28% bracket, now it shows us actually, because now we don't have the $1.3 million down there at the bottom of the account value, only have $1.1 million. What it shows us is we'd actually have to push that up to 4.65 to be able to get to that same number. And we could put that in there if we wanted to, just to show, yeah, now it takes 4.65% every single year. And if we could do that, we would have the same $1.3 million we had in cash value in the life insurance policy. Not better, and a long way from guaranteed, right? Would we have to, if this was in a bond portfolio, would we have to pay commissions, fees on these dollars in this account every year? And so let's put management fees of 1.5 points. And now it shows us we'd have to earn 6.2% every year. And that's not an average, but every single year. We couldn't have any down years or anything else along the way. And that's what it would take just to equal that piece. And it's still leaving out another part. And that is when we have the whole life insurance, it comes with this fabulous return on cash, but it also has a death benefit that's growing along the way. So if we chose not to put money in the life insurance policy and we still wanted to protect our family, at least for a period of time during our working years, what would we do to be able to do that? We'd have to take on another cost. Yeah, we'd have to buy term insurance, right? Take on another cost. So if we include some term insurance in here, and here's an interesting thing that happens with our term insurance. Oh, we don't have term in here yet. Oh, yeah. Let's import some term.
There we go.
All right. So here's $1 million term policy. And if we were to do that, it has a premium here of $1,385 per year. Or sorry, $1,305 per year. And if we scroll down on this, I'm just curious. Okay, so you stopped at that point in time. Great. So here is getting rid of this at this point in time. And we would be forced to one way or another. Some insurance companies will let you extend it beyond. But if you were to extend this, the premiums would probably jump to $25,000 or $30,000 that next year. So in all sense of it, the term insurance is going to get canceled here. And what we see now, if we look at our return again, up at the top of what it would take, now we would have to earn 6.67% every year so that we could pay the taxes and the fees and buy some death benefit for part of the time frame that's not going to be there for our whole life. And there's an interesting piece here. And it's this idea of having insurance for the first part of our life. And if you can qualify for the insurance, what do you think the likelihood of a premature death is between, say, now and in this case, age 70?
Lower.
It's pretty low, right? I mean, it's something we need to insure because it could be us out of that pool that it happens to. So we need to take care of it. But the reality is it's pretty unlikely, but we're forced off the risk at a time when, look from, what do you think the likelihood of death is from age 70 on? It's pretty much guaranteed.
100%.
Right. And so we're encouraged to have the insurance in the short run and get rid of it when the return on it's guaranteed. So it's really kind of backwards thinking. And again, I'm not saying don't have term insurance. We need to make sure that our family's protected in those early stages. But if we look at the statistics, the likelihood of an early death is way smaller than the guarantee of it happen, over our whole life. So it's kind of a backwards argument. And 6.67 is what we'd have to earn day in and day out. And so some people could look at this and say, well, 6.67, I could do that elsewhere. But if you did do that elsewhere, you would still only be as good as the life insurance cash value and you'd lose the death benefit. So it would have to be way better than that to be a better benefit than what we have here. And the second piece is, what would it take to do better than 6.67? Well, we certainly couldn't do it with bonds, which is more of a like asset here. So that pushes us into the equities piece, which means we would have to have a portfolio that's a mixture of equities and bonds. But to do 6.67 with that combination, we'd probably have, even in, say, a 60% equity, 40% bond split, to do 6.67, we're going to have to earn probably 12% every year to make that happen with no down years. So it's kind of interesting that life insurance is considered a terrible rate of return, and yet look what we would have to earn elsewhere to keep up with it. And if we take this back down and look at this in a different light, let's look at this more, take the fixed earnings rate here, and let's go to, say, if we're talking about bonds, make it 4%. So if we look at a comparison with bonds, and then let's look at the graph. I know looking at all these numbers gets a little confusing, but let's look at it in a form where we can actually see what's happening here. So here, I'm going to start with the blue line. That is the growth of the cash value. And you can see early on, it's actually behind having in that 4% account. And again, early in the life insurance policy, it's got a low rate of return, but it overcomes that as time goes on. And so in this case, at about the 10-year mark, it actually goes past that and quite a bit past that, so that at the end of this time frame, there's a good $500,000, $750,000 more out there at the end of that time frame. And then let's look at the death benefit. So all along the way, our family was protected with this purple line on the life insurance. And the gold line is the term insurance here, and we can see where it fell off. And when that falls off right there at age 65, we can see that's when they become self-insured, right? And a lot of people talk about that like it's a good thing to be self-insured. I don't totally understand it, because insurance companies have all the stats. They know how many people are going to die each year. They know how many buildings are going to burn down each year. They know all of that because they've got a huge pool to pull from. As individuals, it doesn't make sense for us not to use an insurance company or a bigger pool. In fact, that's where the mutual life insurance companies came from, right? Early on, somebody would die in a community and it would wipe out that whole family for, who knows how long. And so people started figuring out, wait a second, it looks like only one of us or two of us gets this problem every few years. What if we all started throwing money in the pot to take care of those odd people that it happens to? And so that's kind of where the base of it came from. And so using the insurance company's pool makes a lot more sense than being self-insured, right?
Todd, to that point, what is if we think about insurance, that's just a transfer of risk. Right?
Yep.
So either you have insurance or you don't have insurance. There's really nothing saying that you're self-insuring. So you either transferred away the risk of you dying, and up to the point like we're here where we drop the term insurance. So now you don't have the transfer of that risk when your likelihood of dying is great. So are you wanting to transfer that risk away to somebody else that can handle that risk?
Yep. At a much more efficient cost, right?
Right.
I mean, if you were the lucky one that it didn't happen to, then, you made out. But boy, you talk about a gamble.
And what's nice about with the whole life is that it's not like it's money washed down the rat hole.
Yeah, that's the coolest part. And that is, I think, in most people's minds, certainty, protection, those things are perpendicular or opposite to wealth accumulation, right? In other words, we can either have certainty and protection and those kind of things, or we can have wealth. And quite honestly, it's because most financial strategies are set up that way, right? Because of the way they're doing certain things. But if the right strategy's in place, they can actually be on parallel paths. We can have both. And that's what we're seeing here, right? We can see, wait a second, we have a huge amount of protection and certainty with this life insurance piece, and we have more money, not less, like so many people think. And I think most people, if you asked them, they would say that if this was a slight cost, that they would rather have 100% likelihood of getting to 95% of their target wealth than a possibility of getting to 100% with a strong likelihood of way less than that if things didn't go exactly as planned. And we know it's not going to go exactly as planned. We're going to have life-changing events that are going to continue to occur out into the future, right?
Yeah, and we're doing that by using a contract where this is what the beauty of it is that we're using a contract that's really set up with the whole life policy. It's just set up as a professionally managed bond and real estate portfolio being done at this very high institutional level with a guaranteed never to go backwards. I mean, I don't know how it gets better than that for what you're having to take on. You've transferred risk, you have a guaranteed never to go backwards, and you have a portfolio that's being done for your benefit at a very high level.
Yep.
And the analogy I'm thinking of, and maybe this is a poor one, but like we talked about the casino in an earlier episode, and the house always wins. And so what would a guy like me do? Well, I don't go into the casino in the first place. That's my hedge against that, right?
Yep.
But imagine if you could go into the house and you could get on their side of the equation. That to me is kind of like what people are doing when they're like, I'm going to go self-insure. You absolutely can do that. Or you can go into partnership with a strong mutual company that has all the mortality tables, so you know your cash is going to be connected to their type of portfolio, which gives you that level of protection. To me, I love that option. And I want to just bring back a few points just to connect everyone listening to this with some of the misconceptions, because what we heard and what we hear a lot from individuals on stage is, whole life, it's expensive and it's got a low rate of return. You should just pay, let's say, Goldman Sachs a couple of points to manage your money in the stock market, and you'd be so much better off because you're going to earn an average 5 to 6% more than the whole life. So problem number one is people are talking about whole life as an investment, which it is not. It is a guaranteed asset, which separates it from that conversation is the first problem. We have to compare this value, this earning rate in the policy to other cash equivalents, which is the money in my safe. That's the money in our checking account, the have-to money in case the emergency comes up, right? So right there, it's not an investment. And then two, it's expensive to own. So you might as well not pay it because you could just buy the cheap term insurance. And even that, the cheap term insurance is a bad plan because those greedy insurance companies take all your money. This is like verbatim what we were hearing at this stage or at this convention from their leader speaking from stage. So anytime I hear someone call whole life an investment in the same sentence, I already know their education around this is so low because they can't even correctly identify what type of asset it is. So can we talk quickly, Todd, about term is very cheap, whole life is expensive, and how the insurance companies look at that? Because we know they price those products perfectly for what they are and what they'll do.
Yeah. So, something I learned from my mentor, Norman Baker, and it's something that I use all the time in my thought process when new products come along in the insurance industry or wherever else. And the line is, there are no deals in the insurance industry, right? And that doesn't mean just the life insurance industry, it's insurance as a whole. There's no deals. Everything for the insurance company is a trade-off between cost and risk. So if something is, quote, cheap, it's because the insurance company has less risk involved in that. And so, think about it with a building. Like if you're insuring a building, there's a lot of similar points. Can you insure the building for more than it's worth? No, right? Well, you can't insure your life for more than it's worth either. The insurance company has the same actuarial tables. And so it's going to be for whatever your economic worth is how that works. The other piece is if I have a building and it's, say, got a likelihood of floods and the insurance company puts an exclusion for flood insurance on there, they've gotten rid of some of their risk. And what's going to happen to the premium? It's going to be less than if they included that in the conversation. So the same thing happens. Everything's a trade-off between risk and cost. And so when we look at life insurance and those two extremes, if we look at term insurance that has a very low risk based on that conversation, what we can know is it's because the insurance company has very little risk, right? The likelihood of something happening in the short run for somebody who can pass the requirements for getting the insurance health-wise means there's a very small risk that the insurance company is going to have to pay off. On the other extreme, a whole life insurance is not more expensive, it has a higher premium. Why does it have a higher premium? Because it's there for your whole life. It's guaranteed to be paid out by the insurance company. So there's an extreme difference between those two things. And so what we're looking at here, when we looked at the funding calculator, what we saw was, hey, we put in X amount of money and we end up with a great return and have that money plus earnings out into the future. So did that really have a cost for the insurance? And so, versus when we look at term insurance, the only way we collect a term death benefit is if we die. So literally we're buying something, we're paying for something that we hope we can't collect on, right? And in the ideal scenario, in the most likely scenario, that's probably what's going to happen. And so let's look at that just quickly, just with a calculator. So the life insurance has recovered all its costs plus when we're talking about whole life insurance. But if we look at that term insurance premium of $13.05, and let's get a future value calculator. Again, when we go out at a time, we can't just accumulate numbers because that money, if we didn't have the term costs, we could put it in an investment somewhere. So the annual payment of $13.05 for 30 years at, say, a 4% net earnings rate, that's a $73,000 cost for something we hope we don't get. So it is kind of backwards. People look at the lower premium and they say, oh, this is cheap compared to whole life insurance that has a higher premium, in this case, $20,000. But really, what is cost? Cost is when we don't get anything for what we have. So putting $1,305 in here a year, taking $73,000 away from other investments to get nothing, ideally, versus putting $20,000 in per year to get $916,000. That cost is a different scenario. Yes, there's a difference in the premium, but term insurance is not cheaper than whole life insurance, right? It's all actuarially based.
And I think that's the point that people have to make. It's not that the greedy insurance companies are there to get you. They've built pricing into their products that are perfect for what it is based off your age, sex, and health. So the individual that we were listening to speak, he said, when I go into Best Buy and I buy a TV, they say, do you want the warranty? He said, no. And he said, why would I get the warranty? My TV never breaks. And I came home that night and I talked to my wife and I said, Diane, listen to this analogy. And, I was laughing about it because I'm like, you're comparing a TV to your life. And I'm like, imagine if you went into Best Buy at 25 and you could buy one TV in your whole life and it had to last you. And you had to have this TV for every other aspect in your life. Would you get insurance on that TV? And the answer would be yes.
Yes.
And so it's when you run it out, the term is priced perfectly for what it is. But something that I've learned from Wade is people love having something. And once they're used to having it and it goes away, it's going to cause some chaos in their life. So at 60, now when your likelihood of passing away is going to shoot up dramatically and you lose that $1 million term because there's no way you're going to renew it at the new pricing that they have to charge you for because of the risk, you would have been better off paying premiums into a whole life, knowing that's going to be there in the long run. So the fact that whole life is expensive, we have to go back to compared to what and over how long. If you're only going to keep whole life for 3 to 5 years, yes, probably not your best choice. So don't buy it if you have a 3 to 5 year plan. But the policies that Diane and I own, we've ran out how much premium we'll pay at a realistic time that we'll pass. We will pass that death benefit on to our 3 boys for 22 cents on the dollar from what we pay in premium. That is an extremely cost-effective place for my cash to reside during my lifetime in this private liquid asset. And so the longer it's in place, hopefully our whole life, the cheaper that actually becomes for us long term. And so it's always out of context, though, when we have people talking about this that just aren't educated on what to look. And then next we have the rate of return. Also compared to what? Compared to an investment vehicle, I hope in their investments they're beating 6.67. I hope they're in the 10% range if they're really good at investing. Most investors that I work with are easily hitting that in their portfolios, but they understand what they're investing in. So when we take the savings component of the whole life policy, compare it to the investment grade returns, and then we say one is low, one is not, once again, it's completely out of context, which is why I love this calculator so much. It really just puts the numbers behind what's actually happening so that we can make better decisions in the future.
Yeah, that's awesome. And there's another piece that's kind of, we have to think big picture about a little bit, and going back to what you were talking about on that 10% and hoping that your clients could earn that in their investment side. But if they're earning that in a regular equities type portfolio or anywhere, are they going to have certainty assets as part of that investment, knowing that those fluctuations are going to occur there? And the answer most of the time is yes. And so even in those scenarios, here's what's crazy is when you look at the equities market, they're looking at life insurance as being their competition. And if they were smart, they would really embrace life insurance as taking over that bond portion because it's earning so much better than the bond that what would ultimately happen is if they replaced the bond portion with the life insurance certainty, it would allow the equities to get even bigger because they wouldn't be pulling money off the equity side to keep that balance in place nearly as much. So it's funny, when you put life insurance to take care of part of that side, the equities get bigger.
And this just goes back to something you said on the earlier episode, Todd, is when you really go up, the financial food chain to the biggest players, they know this stuff. And it's why they partner up with life insurance companies, because there's no one better in the world at mitigating risk with that long-term of a perspective than these big mutually owned life insurance carriers. It's such an advantage that we as potentially small players in the money game can tie into and get the same economic benefits that giant corporations, large banks all get access to because they're just playing the money game a little bit differently than we are.
I was just gonna say that, Kyle. It's funny you said that too. Like when you take it to extremes, while the banks and the large economy has $1 quadrillion in derivatives around the world in a scary sense, also the Fed is calling cash values on life insurance tier 1 capital to anchor that risk. Think about that.
Yeah.
That's in the B's and the T's, billions and trillions. At the UME level, it makes only sense to get certainty guarantees to anchor whatever else we do. And the fact that you said this also, Todd, is an asset, right? It gives you the possibility to expand what you're already doing. It's not a trade-off. So
yeah, and really what we've talked about here in this segment is just during the accumulation phase, and we really haven't even looked at the impact having that in place, what that allows us once we move into that distribution phase. And I would say that as fabulous as life insurance contributes to the accumulation side, its presence during the distribution side is even bigger. A good friend of mine always talks about, life insurance paired with another asset always makes that other asset better.
And this is why understanding the math and the economic benefits that life insurance provides is a support and an enhancement to whatever else we're doing in our big wide world. And so hopefully what we learned and took away from this is, one, term is not cheap and whole life is not expensive. They're priced perfectly for what they do. And whole life does not have a low rate of return. I would actually say it has one of the highest, if not the highest rate of return as a savings environment, with the protection and liquidity that you can use to accelerate your stock market portfolio. And so, Todd, thank you for spending the time with us to go through some of these concepts and talk through these ideas. We've got a lot more resources on our website, factumfinancial.com. You can also go to truthconcepts.com and see all of Todd's information. He also has trainings. If you're an insurance agent, I highly recommend that you go to at least one Truth Concepts training. They're very in-depth. You'll learn all the math and the numbers behind what's going on. And Todd, I just want to say thank you again for just pouring out so much value to us. And we will be sharing this with all of our clients and future prospects. So we just thank you tremendously.
Great. Thanks for the opportunity. This is really a passion of mine. So I'm just glad to get it out there, get people on the right track. I think, it's one of the things, if people can understand how this works in the right picture, they can actually extend that out to other things that they're doing, just that logic cycle. And I think we could fix the problems that we see in this country financially.
Could not agree more. Todd, thank you again so much for your time.
Thank you.
Todd.